Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Zebra Technologies Corporation Annual Report. Zebra Technologies Corporation offers a wide range of products and services to various industries worldwide. In the connected frontline segment, the company provides printers that produce labels, wristbands, tickets, receipts, and plastic cards. These include dye sublimation thermal card printers for personal identification, access control, and financial transactions, as well as radio frequency identification, device, RFID, printers that encode data into passive RFID transponders. In addition to printers, the company offers various accessories and options, such as carrying cases, vehicle mounts, and battery chargers. It also provides stock and customized thermal labels, receipts, ribbons, plastic cards, and RFID tags for printers. Furthermore, Zebra Technologies offers electronic sensors and temperature monitoring labels. The company's asset visibility and automation segment includes a range of products and services, including fixed readers, RFID-enabled mobile computers, and RFID sleds. It also provides tags, sensors, exciters, middleware software, and application software. Additionally, the company offers physical inventory management solutions, rugged and enterprise-grade mobile computing products and accessories, as well as real-time location systems and services. Zebra Technologies' product offerings also include barcode scanners and imagers, RFID readers, industrial machine vision cameras, and fixed industrial scanners. The company provides point-of-sale solutions, self-serve kiosks, and interactive touchscreen displays. Its workflow optimization solutions include workforce management, workflow execution and task management, prescriptive analytics, and communications and collaboration solutions. The company's cloud-based software is another key offering, providing customers with flexible and scalable solutions for their business needs. Zebra Technologies serves various industries through its direct sales force and network of channel partners, including retail and e-commerce, manufacturing, transportation and logistics, healthcare, public sector, and others. The stock price of Zebra Technologies Corp. Has experienced significant drops in the past year due to several news events related to its quarterly earnings reports. One major event was the Q3 2025 earnings report on October 28, 2025, where despite reporting stronger than expected earnings per share and revenue, the stock plummeted by over 16%. This decline was attributed to broader market concerns, volatility, and investors focusing on the company's future outlook. The perceived slowdown in organic growth, estimated at 0% to 2.5%, spooked investors, causing them to reevaluate their investment in the company. Additionally, a 26% drop in net income from the prior year due to higher expenses further contributed to the decline. Another notable drop occurred following the Q3 2025 earnings report on August 5, 2025, where despite exceeding analysts' EPS expectations and meeting revenue forecasts, the stock price later declined by 10.63%. These events collectively led to a significant drop in Zebra Technologies Corp's stock price over the past year. Zebra Technologies Corporation maintains a market capitalization of $13 billion, broadly in line with the industry peer group. Zebra Technologies Corporation trades at a higher price-to-earnings ratio of 32 times and a higher price-to-book ratio of 3.66 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 58% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline for Zebra can be identified through an examination of its financial reports. On one hand, the company has experienced revenue growth due to several key factors. The acquisition of Allo Holdings, Inc. has contributed significantly to this growth, as have increases in inventories and amortization expenses related to contract costs. However, there are also drivers that have led to a decline in revenue. A notable decrease in services and software revenue in both the CF segment and AVA segment has been observed. This decline is attributed to a 2% drop in the CF segment and a 1.8% drop in the AVA segment. In terms of segment performance, the CF segment has seen growth in tangible products, driven by a 12.6% increase. In contrast, the AVA segment has experienced a more modest 7.8% increase in tangible product sales. The geographic breakdown reveals that revenue is generated from various regions, including North America, EMEA, and US. The financial reports also highlight tax-related items, such as tax benefits related to foreign earnings subject to U.S. taxation and the generation of tax credits. These factors have contributed to the company's overall financial performance. The fluctuations in net income and profit margins from 2023 to 2025 were significant. Initially, net income decreased by $109 million, minus 20.6%, from 2024 to 2025 due to various factors, including an impairment of goodwill and intangibles worth $45 million. However, when comparing the 2 years directly, net income increased by 13.3% in 2025 compared to 2024. Profit margins also underwent changes during this period. The gross margin decreased by 0.3% in 2025 compared to 2024, while the operating income as a percentage of net sales increased by 1.6%. Furthermore, the gross profit margin saw a decrease from 48.4% to 47.2% from 2024 to 2025. The effective tax rates played a crucial role in these changes. The decrease in effective tax rates from 21% in 2023 to 25.2% in 2025 resulted in an increase in net income, contributing to the overall fluctuations observed during this period. The company's financial performance indicates a steady generation of positive operating cash flow. According to the provided summaries, the net cash provided by operating activities has been consistently high in both 2024 and 2025, with figures of $1,013 million and $917 million respectively. This suggests that the company is able to fund its expenses and pay principal and interest from its operations. Furthermore, the free cash flow for these years stands at $954 million, 2024, and $831 million, 2025, indicating a strong ability to generate cash from its core business activities. Although there is a slight decrease in operating cash flow in 2025 due to factoring arrangements, which resulted in a lower figure of $560 million, the overall trend remains positive. Overall, these financial metrics demonstrate that the company is generating sufficient cash from its operations to meet its expenses and obligations, indicating a healthy financial position. The company's debt level has experienced a significant increase over the past year. According to various reports, total debt rose from $2.183 billion in 2024 to $2.511 billion in 2025, representing a 14% increase. This upward trend is further supported by an estimated fair value of debt that increased from $2.2 billion to $2.5 billion during the same period. In addition to the rise in debt level, interest expenses have also undergone changes. Initially, there was a decrease in interest expense, net from $133 million in 2023 to $98 million in 2024. However, this trend reversed in 2025, with an increase to $108 million. Furthermore, interest paid, net of forward interest rate swaps, increased significantly from $55 million in 2024 to $129 million in 2025. The inconsistencies in the numbers across different pages highlight the need for further clarification on these changes. Nonetheless, it is evident that both debt level and interest expenses have undergone notable shifts over the past year. The performance of various regions, segments, and sales channels has been analyzed in the given summary. On a positive note, the Asia-Pacific region recorded a significant growth rate of 16.5% in 2025 compared to 2024, followed by North America with an 8.1% growth and Latin America with an 11% growth. In terms of segments, mobile computing is expected to drive revenue growth, while data capture is anticipated to contribute to growth through technology transitions. Tangible products also performed well in both the CF and AVA segments, with projected revenues of $2,156 million and $2,262 million, respectively, in 2025. The sales channels also showed promising results, with distributors and value-added resellers, VARs, direct sales force, and original equipment manufacturers, OEMs, performing well. On the other hand, services and software recorded a relatively low growth rate of 1.3% in 2025 compared to 2024. The corporate segment also reported an operating loss of -$399 million in 2025, indicating poor performance. Management's outlook for the company is one of continued evolution and advancement in its vision of digitizing, automating, and intelligent frontline operations. The company aims to unify teams, customers, and AI agents to deliver enhanced frontline experiences through its connected frontline segment. This involves leveraging a combination of on-device and cloud-based AI to augment worker productivity and provide real-time assistance. The company is expanding its reach beyond the traditional AIDC market by transforming various activities such as factory production, supply chain management, retail shopping, hospital patient journey, restaurant self-service, and public safety and emergency situations. To achieve this, the company is investing in acquisitions to expand its portfolio of self-service and consumer-facing workflow offerings. Management also emphasizes the importance of organizational design changes, citing the 2025 Productivity Plan as a key initiative to meet strategic objectives and improve cost efficiency. Additionally, the company is committed to creating an environment that fosters continuous learning and career development, which it believes will increase innovation and drive success. Overall, management's strategy involves leveraging technology transitions and share gain opportunities to drive revenue growth, while advancing its vision for digitized, automated, and intelligent frontline operations through end-to-end solutions. The company expects to fund expenses and pay principal and interest on indebtedness from cash flow from operations. The company's financial strategy has been focused on reducing its outstanding shares through a series of buybacks. As stated in the company's reports, a total of 1,177,238 shares have been purchased to date. This move is aimed at increasing shareholder value and potentially boosting earnings per share. The company has also indicated plans for future share purchases, with an approximate dollar value allocated for this purpose. Concerns about inventory buildup and supply chain disruption are evident in various sections of the report. On page 18, third-party electronics manufacturers' failure and longer production lead times contribute to these concerns. Similarly, on page 19, volatility in customer demand, transport costs, sole-source suppliers, and limited sources exacerbate the issue. The problem persists as highlighted on pages 35 and 58, where increased inventory-related charges and lower sales of data capture and printing products are mentioned alongside high inventory levels. These factors collectively indicate a pressing need to address supply chain disruptions. Furthermore, potential risks and challenges that could impact supply chain disruption include geopolitical turmoil, volatility in foreign currency rates, imposition of burdensome trade policies, transportation delays, customs-related delays, global supply chain challenges due to public health issues, and local outbreaks disrupting operations or those of suppliers, customers, or vendors. That concludes the financial summary for Zebra Technologies Corporation. Feel free to comment below, and I will be happy to answer them when possible.